So, welcome everyone back to the introduction to banking. We are now in section 3, central banking. I told you last week that if you talk about banks and banking in general, you need to talk about central banking, at least to some extent, because banks, as you know, do not only engage in business in a highly regulated sector, but this sector also has this peculiarity that its main product, capital, money, is actually first supplied by a central bank. And the supply of money is governed by a central bank, and this has an influence on all the business banks do. So we'll talk about central banks, how they create money, but also how they supervise and regulate banks. And we'll talk a little bit about the US banking system as an example of a very large, actually the largest global banking sector. That is highly regulated, includes a number of supervisors, and then in the end talk a little bit about supranational banks. So monetary policy in almost all countries is done and is conducted by a central bank, and usually modern central banks serve the main purpose to secure price stability, to combat inflation, and subsequently only support general economic policy. I say in modern times central banks do this because in ancient times central banks had almost only one function: to finance the local lord, die Fürstenfinanzierung. Central banks were meant to take in taxes, to print money, and to support the local feudal lord. Nowadays, in modern times, central banks usually have the primary goal of combating inflation and deflation, keeping inflation at a certain level, guaranteeing price stability, and then subsequently supporting general economic policy. Now, moving from one country to another country, it might be that combating inflation is more or less important. For example, in the United States, the Federal Reserve System is rather famous for having a much more loose stance on inflation and combating inflation, and being known for relying a little bit more on overall support for general economic policy. That is why, for example, right now Donald Trump looks for the Federal Reserve to support his economic policy, whereas in the European Union, especially in Germany, we are extremely averse to the idea of central banks supporting governments. We don't want that. We want our central banks to be completely independent from politicians. Now, depending on their legal form, central banks differ from other state institutions in terms of their tools and their independence from other state institutions, differences from country to country. Some very strange examples. Sometimes you have a central bank that is actually a listed corporate public corporation. For example, the Swiss National Bank is a stock corporation, and you can buy stocks from the Swiss National Banks. You have a stock price, SNB, Schweizerische Nationalbank, SNB. Now, the tasks of the central bank in Germany are carried out by the European Central Bank and Deutsche Bundesbank, the German central bank, within the system of European central banks. This is important to understand how this works. It used to be that in Germany we only had one central bank, Deutsche Bundesbank. But nowadays, with the European system of central banks, it works like this. You have the European Central Bank that sets out the rules and is responsible for general management, for top management. Now, monetary policies are laid out and are decided on by the European Central Bank. The European Central Bank has, as you probably have heard, now has a new president, which is Christine Lagarde. The head board of the European Central Bank, that is headed by the president, decides on general policy. It is supported by the directorate, a set of directors, executive directors, who do what? The executive directors, they implement policies set out by the Council and the ECB President. So top management, European President of the ECB, day-to-day operations and implementing general policies, executive directors. If you have read some German newspapers, you might have heard that we are currently proposing a new German executive director, colleague Isabel Schnabel from University of Bonn. And then the European Central Bank decides on monetary policy, and the decisions by the European Central Bank are then executed by national central banks. So in a sense, the national central banks like Deutsche Bundesbank have lost some of their independence and some of their say to the European Central Bank because they only have to execute the orders and the monetary policy that is decided upon by the European Central Bank and the Council. So this is how it works in the Euro system. But let's start a little bit more generally. What is a central bank? And I know some colleagues from our macro department and some macroeconomists would probably not agree on this, but I think it's instructional to think about a very simple model of a central bank. I know this is simplistic, but let's do it anyways. Imagine you are the head of a state of a small island republic. And at some point you realize it would be nice to have our own currency. People can trade, we'll have money. So what do? You open up a central bank. And what is it a central bank does? It prints money, in a sense. It gives out a currency. What is a currency? A currency is nothing but the promise that the central bank will accept the notes and it will give you some other asset. And this is how, in ancient times at least, central banks came into existence. What they did is they printed money, they gave out notes, and those notes were liabilities. And you can still see this on the pound notes, on the British sterling. It says, Chancellor of the Exchequer or the Treasurer of the Bank of England, I promise to pay the bearer of this note in the amount of £5. It's a promise. It's more or less an IOU. Okay. So it's a liability. It has to appear on the liability side of the central bank's balance sheet. How do you finance these liabilities? Because it's a debt. Any idea? Imagine you want to start the circulation of 1 million, I don't know, island dollars. We call this island dollars now. We create a new, or let's call them bit dollars. Yeah? Not Bitcoin, bit dollars. We want to start circulation of a new currency. And we need 1 million of our new currency. So the liability side includes debt in terms of 1 million bit dollars. How do you finance this? You buy up assets on the market. And what assets were initially bought by central banks? Gold. Yes. So on the asset side, you keep your currency reserve. Usually, traditionally, foreign currencies, gold. Then you start with a very simple balance sheet that has gold on the asset side and banknotes on the liability side. And one would be done. And you accept assets, could be gold, could be foreign currencies. You start buying up assets and you print notes. And you're done. You have your central bank. Now the central bank can do more. It can offer loans to banks. So it will have refinancing of commercial banks, main and longer term refinancing operations on the asset side, and it will also give out loans and accept loans from banks. So asset and liability side, refinancing and financing of commercial banks. It can also grant loans to the state. Usually we prevent that from happening, and usually we have rules in place that disallow central banks to engage in a direct financing of the state's budget, but theoretically it could so. And gold and current foreign currencies are not the only assets you can buy. You can also buy securities, and this is what we call open market transactions. You buy up securities on the market, and this is how you control money supply. What you do is, imagine this is your asset side and your liability side, and you've bought up gold and you've given out notes. If you now buy an additional $2 dollars worth of securities, suddenly your asset side increases to this, but the liability side has also to increase. So what you do, you print money and you increase your total assets of your balance sheet of the central bank. You give out more loans and you increase money supply. Very simplistic. That's okay. And these are called open market transactions because you engage on the open market to buy up securities or to sell securities to increase or to influence money supply. Then the liability side is quite clear. You have some state deposits. This is okay. Why? Because if it's not meant to finance the state's budget, if it's meant to act as the state's bank, this is not a problem, and this will only be a minor position on the liability side of the central bank. By the way, if you have already paid your semester fee, you might have seen that, at least here in Saxony, most of the government institutions have an account with Deutsche Bundesbank. So it becomes quite clear, and it's a very practical example that the central bank, in this case Deutsche Bundesbank, also keeps the accounts of the state. So you pay on the account of the state and taxes will be paid to the state, and these accounts are kept by Deutsche Bundesbank. Okay. So cash management, account management for the public sector is done, but also you have the deposit facility. Banks can deposit money with the bank, and then it's also a liability, and you issue banknotes. So that's the liability side. If you have a look at the balance sheet of the European Central Bank, you see exactly this: gold reserves, banknotes, intra-Eurosystem claims, and so on. And one difference is that in this case, you also include the profits here. One thing, you need to remember this. Can you give me your opinion on the balance sheet, on the total assets of the European Central Bank? It was in 2013, but nevertheless. Any idea when it comes to total assets? It has a total assets of 174 billion euros. 174 billion is 1/6 of Deutsche Bank. It's ridiculously small, but why? Deutsche Bank, a private bank, has total assets of somewhere between 1 and 2 trillion euros. They have had 174 billion. Why is that? Remember again the system, the European system of central banks. The European Central Bank is responsible for managing monetary policy in general and at the top level. And everything that is decided upon by the ECB is executed by national central banks. So if you are hearing, oh, the European Central Bank has increased money supply, we are swimming in money, etc., etc., This pops up in the balance sheets of national central banks because they are the ones who have to execute the decisions by the European Central Bank. The ECB itself has a rather small balance sheet. This is important to see here, because a couple of years ago students asked me, how can it be that the European Central Bank has such a small balance sheet? It's because most of its operations are done by the national central banks. This is the income statement. It's okay. And I've already talked about this. The European system of central banks is what we usually refer to when we talk of the European Central Bank, the ECB. It's not the European Central Bank. This is just the head institution, usually call them or use those words synonymously. And most importantly, the European system of central banks is not equal to the Euro system. The European system of central banks is not equal to the Euro system, and this has to be kept in mind. So, for example, countries like the United Kingdom, who have, they will be out anyway, but countries that do not have the Euro are still included in the European system of central banks when it comes to certain aspects of central banking, but not obviously when it comes to monetary policy in the single currency. Primary monetary objective is to guarantee price stability with an inflation goal of less than 2%. Secondary objective is the support of economic policy and supporting economic growth within the European Union. And the specific tasks are setting rules and implementing a common monetary policy, exchange rate policy when it comes to the euro, but also the other European currencies, managing foreign exchange reserves, supervising credit institutions. Does anyone know which credit institutions are supervised by the ECB? Only the SIFIs. What are SIFIs? Anyone? Systemically important financial institutions. We will see in a bit that we have 3 regulatory bodies and 3 supervising agencies that supervise banks in Germany. European Central Bank is responsible for the large ones, for the systemically ones. BaFin is responsible for general supervision and setting general rules for supervision. Deutsche Bundesbank is responsible for day-to-day supervision on a regular operative level. And ensuring functioning of payment services, provision of money, that's also clear. European Central Bank, located in its shiny new headquarters in Frankfurt, is governed directly under European Union law and has been the common monetary authority of all member states, not just the Euro states, since 1998. In addition to the above-mentioned objective, it also performs other tasks. For example, creation of the central bank balance sheet, collection of necessary statistical data. And it's safe to say, if you are interested in economics, if you complete your master's degree or even do a PhD, European Central Bank is probably the best of the best employers you can imagine. It's one of the few jobs you can get working at the statistical or research department at the European Central Bank, usually one of the few jobs that will be most coveted. Why? First of all, European Union jobs are always very famous and always students' favorites. You're not working for the private sector, you're working for the light side. Yeah? You're not working for the empire, you're not working for McKinsey or Boston Consulting, but you're working for the good ones. You're working for the greater good. First, that's actually true, and that every student thinks so, that's true. I still remember all my fellow students, they all wanted to go to Brussels. It was a long time ago. You work for the good guys, you work for the greater good, you work for the public. Second of all, you do something that is very related to economics, because if you're studying economics, it's very difficult to find a job in economics, actually. This one is. And best thing, the salary is close to the ones you would get paid at an investment bank. They pay ridiculously high wages and salaries as a result of the fact that it's partly tax exempt. If you're interested in a great salary but still working for the state, supranational organizations. I once met a colleague who works for the IMF, the International Monetary Fund. And he was younger than me, and he was complaining that the local BMW car salesman in Washington, D.C. doesn't give a diplomat discount. If you work, for example, for the IMF or even for the World Bank, you're officially a diplomat. You have diplomat status. That's very nice. And you're tax exempt. You don't pay taxes. Same with NATO. And European Central Bank also has some special laws concerning that. So these are very, very cushy jobs. They do a lot of statistics, a lot of research. They supervise systemically important banks as a result of the introduction of the SSM, the Single Supervisory Mechanism. What is the SSM? Single Supervisory Mechanism. It's a framework. If you ever hear these words like European Banking Union, European Banking Authority, especially Banking Union and the SSM, sometimes they are called a framework. What it means is it's simply a set of rules and a set of mechanisms that try to harmonize the banking sector within the European Union. For example, the European Banking Union is just the introduction of the SSM, new rules that were installed, the European Banking Authority, the EBA, and so on. And within this framework, the ECB has taken over the supervision of systemically important financial institutions from national institutions with balance sheet total assets that exceed 30 billion euros or account for 20% of a country's GDP. So it's a relative and an absolute criteria that has to be either fulfilled, either the first one or the second one. So if you're large or if you're relatively large in your country, you will be supervised by the European Central Bank. What instruments does the ECB has? What does it have? It has open market operations, standing facilities, currency interventions, reserve requirements, one has too much, and outright monetary transactions, the OMT instrument. Open market policy is the main instrument of the ECB, more general of monetary policy itself in any central bank. What it does is the central bank uses open market transactions to control market interest rates and the creation of cash. And what it does is commercial banks can pledge certain securities with the central bank. It will have collateral rules and banks will get book money for that. So what you do is, I'm a commercial bank, I own certain securities and I can pledge these securities with the central bank and I will get cash, I will get book money. And I will have to leave those securities with the central bank as a collateral, and there will be rules concerning the collateral requirements and the margins. Say, for example, that if I have 1 billion in completely risk-free government bonds, I can get 800. I can pledge them against 800 million in cash, maybe. You know? And if they are more risky, I will only get 200 million euros from the central bank. The collateral framework is actually quite complicated, that is installed. And it has been changed. And what the European Central Bank has done over the past years, it has changed its collateral framework so that it's easier for banks to pledge securities against book market. Because as you know, as you should know, the European Central Bank is currently following a very loose monetary policy, and it has increased money supply by a lot in order to stimulate economic growth and job creation and investment by the firms. So this is one thing you can do. The most important open market transaction then is the main refinancing instruments. It's the main tender. And what happens in the ECB is you have an auction procedure, and commercial banks may receive central bank money in exchange for interest payments and securities. And since the financial crisis, their main refinancing operations, I hope this is correct, you have to check this, it changes from time to time. The main refinancing operations is currently 0%. So you can get liquidity for 0% at no cost. It used to be different. It's done in an auction. I will come to that, I think, on the next slide. So the interest rate here in this case is fixed, and the banks name the desired money amounts. In the variable interest rate tender procedure, the offered central bank money is allocated to the highest bidding commercial bank. But now, as you can imagine, if you have zero interest, it doesn't make sense to ask banks to bid for the lowest interest rate. If you're offering cash for 0%, you have to switch the auction mechanism. You cannot do a fixed interest tender. You have to do a variable interest rate tender. Is that clear? Because otherwise you would offer, I'm offering 1 billion, please tell me what you're willing to pay. Maybe you say 1%, you say 2%, then you get the money and you don't get any money. But with interest rates at 0%, you will say 0%, you will say 0%, and no one, it doesn't make sense. So this is why they changed the procedure. Now, you also have standing facilities. Standing facility, the term facility is understood as the possibility of standing ready. The central bank is standing ready to engage with commercial banks in investing or receiving short-term liquidity. So what happens is you can deposit short-term excess liquidity with the central bank, or you can get short-term liquidity overnight from the central bank. And as you might know, this is the interest rate that is currently negative at minus 0.4%, which means that you can get money for 0% long-term. If you need cash short-term, you pay the marginal lending rate at short notice. And if you have to deposit liquidity overnight because you have excess liquidity, it will cost you 0.4%. This is the negative interest rate we are always hearing about in newspapers. It's the short-term overnight deposit facility of the European Central Bank. Now a word to my German crowd. In German we have the same word, but in German it sounds weird. Fazilitäten. No one ever uses this word, and I think it is made up. I don't think it's originally from German. Fazilitäten is, if you use the English word facility, it tells you that this is something you can use, an opportunity, a possibility. I don't think any layman, if you ask someone on the street if he or she knows what a Fazilität is in German, I don't think he or she will know. It's a lending facility, it's a standing facility, meaning the central bank stands ready to offer you credit or to accept deposits. That's the standing facilities. Currency interventions. Now, we've seen that central banks also make sure that currency rates evolve in a way the state and the central banks wants it to do. Problem is, currency rates change, sometimes not favorably, and in these cases the central bank might intervene. How do central banks intervene in the currency market? What do? They buy and sell foreign currencies. Can you give me a very good example of a central bank that has done a lot in recent years when it comes to currency interventions. A central bank that needed to intervene quite heavily. No one. No one's reading newspapers, I'm afraid. The Swiss National Bank. With the euro crisis and the euro depreciating in value a lot over the last years, Switzerland had the unfortunate situation that they have a very, very strong currency, meaning that their export goods are extremely expensive. Most of those products are exported to the European Union. And if your own currency is very expensive, it means that you have a hard time selling your products in export. So what the Swiss National Bank did is they kept the exchange rate of the Swiss franc to the euro quite low. How did they do this? Well, you need to do what? You need to, if the foreign currency is very cheap, you need to buy up the foreign currency to increase or to decrease, in this case, the currency rate. Does anyone know what happened? First of all, central banks do something we'll later on see again with the OMT decision. Central banks do not simply buy or sell foreign currencies, they will also tell markets, we want to see the currency rate somewhere between, say, 1 to 120. They will publish a broad range where they want to see the currency rate, implying that if the currency rate moves below or above these thresholds, they will intervene, hoping they don't have to. It doesn't ring a bell, right? Anyone knows what happens with Switzerland? The Swiss national banks did the same. They said, we want to see the currency rate to Swiss franc to euro in this range, and if it moves above, we will intervene. They had to buy up a lot of euro. They reported billions of losses. I mean, it's a bank. A central bank can also make a profit and can make a loss. What happens afterwards? Where do the profits go? State budget. For example, in the case of Germany, our finance minister is always very happy to see some billions coming over from Deutsche Bundesbank to the federal budget. In the case of the Swiss National Bank, the Swiss national banks had to report billions of francs in losses, but they were happy to do so because they kept the currency rate within a certain range. But during the euro crisis, our currency, the euro, lost so much in value, it got even more expensive for the Swiss National Bank to intervene. And at some point, the Swiss National Bank said, we are letting it loose. We are giving up our idea of a range for the currency rate. We are no longer intervening because it has become too expensive. And for some time, people were afraid that the Swiss franc would skyrocket. It didn't really, but this was one side effect of the euro crisis. So, buying and selling foreign currencies, currency interventions. Minimum reserves are another instrument of a central bank. What happens is, you require banks to keep a certain percentage of their business, of their loans, as minimum reserves on their balance sheet. Mindestreserven, die eine Bank erfüllen muss. And if the central bank increases the minimum reserve ratio, it will withdraw liquidity from commercial banks, and this will result in a direct influence on the creation of money and the lending of banks. The current minimum reserve ratio of the ECB is, I think, hopefully, is still correct, 1%. For the Fed, it's somewhere between 0 and 10%. It depends. And for the People's Republic of China, so Communist China, is 14.5%. Does anyone know why, or can anyone imagine why China has a much higher minimum reserve requirement than the European Central Bank? In the end, it's about customer protection. you want to make sure that the bank, if it takes in deposits, doesn't give out too many loans, because loans can default, then there is no money that can be paid back to depositors. So in a sense, it's a mechanism to protect depositors, because you're making sure that the bank that has taken in deposits and given out loans keeps a fraction of those deposits on its balance sheet or as a minimum reserve with the central bank. In China, where you have still an evolving and developing banking sector, where bank failures are still happening, policy and central bank require banks to keep at least close to 15% minimum reserves. In the European Central Bank, where we have different layers of regulation, supervision, and so on, we are saying, okay, 1% is enough. So it is a little bit about customer protection. ECB determines the level of the reserve requirement based on the bank's liabilities that are subject to reserve requirements of the previous month. So it's done monthly. And in particular, these include the short-term deposits. You want to make sure that deposits are covered. Long-term deposits currently enter with a reserve ratio of 0%. And by changing reserve requirements, you can also influence lending and money creation. And liabilities to credit institutions that are holding minimum reserves themselves are not included, and this is calculated based on the liabilities, and then it's compared to the actual reserves each bank keeps on their ECB account. So you have required minimum reserves and current minimum reserves that are available. And then, last but not least, we have outright monetary transactions. What is the OMT decision? What is the OMT decision? Rather famous. Any idea? No one? Anyone from Italy? No one, okay. The European Central Bank will do whatever it takes to save the euro, to stabilize the euro system. This is the famous quote by Mario Draghi: the ECB will do whatever it takes. And more practically, it means the European Central Bank decided in their OMT decision that if everything else fails, and if the rescue facilities of the ESM and the EFSF, those stability mechanisms and those stability funds that were installed during the euro crisis, if those rescue facilities have been used by a member state like, say, Greece or Italy or Spain, if they have been used, the European Central Bank will buy up short-term bonds of countries in the euro area. How does this work? You have to think about what happened during the financial, more or less during the euro crisis. During the euro crisis, Greece, let's take Greece as an example. Greece needed money. Every state, every government needs money from time to time, even the German state. Why? Let's argue. We have a federal budget. I'm actually not sure how much we have now. Let's say 700 billion euros. We are spending 700 billion. We are only taking in 650 billion euros via taxes. Means we have to finance 50 billion. How do we finance 15 billion? We issue government bonds. We issue a new German government bond, and the bond has 50 billion euros notional, and it has a maturity of 30 years, and it pays 0.3%. And you can buy a German government bond, 30 years maturity, 0.3%. Germany even tried to issue a bond with 0%. Now that was worth a try, I guess. If you take a look at the German government bonds from 86, probably nowadays 89 or maybe 1990, you will see 30-year government bonds with 6.5%. We issued a lot of government bonds after 1990. Do you know why? Because we had to finance reunification. German government needed a lot of money, and this is why we issued a lot of government bonds with 6, 6.5, even 7% coupon after reunification. Okay, so we need money. Just like us, Greece needed money. Let's say they also needed 50 billion. They had to repay a bond that was issued in the 80s, and now they need money. Problem is, if you hear that the Greek government and the Greek state is close to bankruptcy and might default on its bonds, would you invest in such a bond? No. Well, then what happens? First of all, if you see that no one's buying your bond, what can you do? Let's offer 2.3%. Let's offer 6%. Problem was with Greece during the Euro crisis, you could see the yield on bonds and the current yield, so the return on bonds that have already been issued, gives you an indication of what market investors think should be the fair return on such a bond. The return on those, the yield on those bonds were close to 15 to 18%. Greece and no other state would ever consider issuing a new bond on which they would have to pay 15 or even 10%. This is when, during the Euro crisis, Greece was not able to finance, to get refinancing from bond markets. In German, we say, ja, Griechenland konnte sich nicht mehr an den Anleihenmärkten finanzieren. Ja, heutzutage sagen wir, Griechenland ist wieder zurück auf dem Anleihenmarkt, kann wieder an den Kapitalmarkt gehen. Ja, Greece was able and is nowadays able again to go back to capital markets. It simply means no one wants to buy your government bonds. Okay, so no one wants to buy them. Problem is, how do bonds react? If it's a government bond that has already been issued, it pays a fixed coupon, say 6%. So what do if you think the 6% is a bad deal? You sell those bonds, bond prices will go down, and if you have a notional of say 105 and the bond price is 50, your yield will be very high because you simply have to calculate 50 divided or 105 divided by 50. This is how it works on the bond market. And what can you do if no one's buying your bonds? You can say, well, the European Central Bank will buy up those bonds. This is what the OMT transaction, the outright monetary transaction decision meant. The European Central Bank promised that as a lender of last resort, if the facilities of the ESM had been used, and if they have been used, then they will buy up bonds of selected Euro countries in distress. And if the European Central Bank says, we will do whatever it takes, we will buy as many bonds as it takes to stabilize the euro, it means speculators can be very sure that market prices will increase again. It will mean that you cannot speculate on getting a cheap deal on those government bonds because everyone knows the European Central Bank will simply buy up the market. And they can because they are creating money. This is here. You have to be careful when it comes to these asset purchases. As you probably also know, the European Central Bank has by now extended its money supply and has seen a huge money expansion, also by buying up assets. But what is the difference between the OMT decision and the asset purchase program of the European Central Bank? We've seen that central banks do this all the time. They buy In open market transactions, they buy assets and create money. But what's the difference between the OMT decision and the asset purchase program that is currently done by the ECB, also done by the Fed, and done by the Bank of Japan to increase the amount of money, the money supply? What's the difference? First of all, there are differences when it comes to what the European Central Bank will buy. There was a huge discussion on whether, what the European Central Bank should buy within its asset purchase program. And you can buy government bonds, but they also buy corporate bonds. So they are indirectly financing corporate debt. Second problem and second difference is, or second distinction you can make is, do you buy it on the primary or do you buy it on the secondary market? For example, the corporate bonds for some time were only bought from the secondary market. So corporations, companies didn't get direct financing from the European Central Bank, but those bonds that had already been issued were bought up to stabilize prices. But what is the main difference between open market transactions and the OMT decision? Open market transactions are limited. The European Central Bank, for example, has a system in place that it tells we will buy 50 billion euros worth of bonds every month. Or we will now increase it to 60 billion every month. But it's limited. The OMT decision meant that they said we will do, again, whatever it takes. No limitation. And this is a promise that should keep speculators in checks. Okay, that's the OMT decision. This is closely related to the function of a central bank to act as a lender of last resort, meaning that if a bank fails, the central bank can give a distress loan to this bank and act as a lender of last resort. First of all, the central bank does this because it fears that problems at one bank will spill over to another bank, causing what we call contagion effects. The idea is that if you run to a local bank and it defaults, other depositors will see this as well and think, well, I might be in trouble. I better run to my bank as well. And then you have contagion. At that point, it's much about herd behavior, herding, and human psychology. I might have told you this. Well, maybe we'll see this later on. A pretty great example from the financial crisis. During the financial crisis in the United Kingdom, there was one famous bank that went bankrupt, Northern Rock. Northern Rock was a bank. It went bankrupt, and depositors ran to the bank, and they demanded payment of their deposits. And if you search for Northern Rock BBC on YouTube, you will find great videos where BBC reporters are interviewing customers standing in front of the branch or in the office of Northern Rock and telling them, you don't have to fear anything. The Chancellor of the Exchequer, so the British Finance Minister, the Chancellor of the Exchequer has said, and the Bank of England have guaranteed all deposits. They said it is safe. And then there's a lady standing in front of Northern Rock saying, well, that's what they said about the Titanic either. So it's about psychology. People will run. They will run, causing one bank after another to get into problems and to default. This is contagion. And this is, for example, in the case of the Bank of England, this is why they stepped in and they guaranteed deposits. And they acted as a lender of last resort because they wanted to prevent this from happening. But still, was no problem for other banks, but still people went to Northern Rock. Please forgive me, it should be perhaps with a P. I don't know how that got in there. Problem is, on the other hand, it creates moral hazard. Who can give me a definition of moral hazard from information economics and new institutional economics? What's moral hazard in economics terms? Moral hazard is a problem that arises from asymmetric information after having closed a contract and after having agreed to a contract. Moral hazard means that you have entered a contract, you or the other party has more information than the other one, and the other one exploiting this advantage in information. Very simple example. In insurance, health insurance, if you buy health insurance, the insurance company will ask you about any existing preconditions, and it may ask you, are you engaging in any risky sports? For example, snowboarding, very risky one, prone to cause injuries. You say no. You close the deal, you have health insurance, and then suddenly you say, well, I never really thought about snowboarding, maybe I should try it. And then you take up snowboarding and you don't tell your insurance company that you're now an avid snowboarder. Problem is, the health insurance company has calculated the insurance premium based on the fact that you are not snowboarding. And you've closed and you've agreed to a contract, and you're now changing your behavior. In a sense, you're behaving immorally. And this is a moral hazard problem for the insurance company, that you change your behavior after agreeing to a contract. And how could it be here? How can it happen in this scenario? It's not a legal contract, but it's a social contract. Banks enter a social contract with the central bank, with us, the general public, that they have to keep extra cash, they have to keep minimum reserves, they have to keep extra capital, and they offer these services, but they also have the guarantee that in an emergency, the central bank will act as a lender of last resort and bail them out. Problem is, as soon as the bank has entered this social contract, they know that we can do anything, the central bank will always save us. And then what happens is bank managers will increase risk-taking. They will exploit this because they now have a fail-safe guarantee. They know that the central bank will bail them out. Funny story. Politicians were aware of this problem. And do you know to what this led? What was the result of politicians realizing that they had unfortunately given out such a guarantee to banks? A couple of years ago, some politicians in the US thought, well, wouldn't it be fun to let one bank go bankrupt, to tell every bank manager, well, it could happen to you, we're not saving everyone. Well, along came Lehman Brothers. That worked out nicely. So you do have a problem. If you act as a lender of last resort, you are giving banks a guarantee that they will be bailed out. And this is why nowadays central banks and supervisors try to single out systemically important banks and to slash them with a mighty hammer of supervision. The only reason why large banks are supervised by the European central banks is because they want to have a closer look at those large banks, and they want to harass them with higher capital requirements. They want to make sure that these large systemically banks are actually really, really safe, 150%. It's a moral hazard problem. And if you have a lender of last resort, an implicit or explicit bailout guarantee, it will distort free competition and free market. If you're interested in this, look at the research that has been done on this. Usually you can find it under LOLR, lender of last resort, or under implicit bailout guarantees or explicit ones. An explicit one is simply that, for example, the SIFI designations, this is actually more of an explicit lender of last resort and bailout guarantee. Because if you are deemed to be systemically important, it means that you have to be safe because you are systemically important. An implicit one is that you might be saved. There are some mechanisms in place. You might be the lucky one. And it creates moral hazard. Banking supervision and regulation. So these are the main instruments and tasks of a central banks. of a central bank. Now let's go to banking supervision and regulation. Why talk about this here? We'll talk about this in more detail later on, but in many countries, actually in most countries, banking supervision and banking regulation is done by the central bank. Anyone from France? No, okay. You are from France? Yeah. Okay. Do you know how it's done in France? Central bank at the top, no, the European Central Bank at the top, of course, for the systemically important banks, but below that. Banking supervision and the supervision of the financial system is done by Banque de France. But it's a division of the Banque de France. It's the Agence de Contrôle Prudentiel et de Résolution, the ACPR. So in France, actually, supervision is done by the central bank or by a subdivision of the central bank. In Germany, it's BaFin, the German Federal Financial Supervisory Agency, in cooperation with Bundesbank. Let's start with the general distinction between regulation and supervision. Regulation, at least to my understanding, is setting the general rules and the laws that govern the banking sector, the financial sector. Supervision is done at the operations level. It's how these laws are implemented, how they are executed. So regulation, setting rules, supervising is the assertion of the rules, executing them that are set by the regulator. So in many cases, the regulator is actually Parliament. It's in some cases also the central bank, but in many cases it's actually Parliament, because most of the important rules and regulations are set in a law. Okay. Well, this brings us to BaFin, Bundesanstalt für Finanzdienstleistungsaufsicht. It was formed in 2002. Up until then, back then things were easy. We had isolated subsectors. Banks never did too much work with insurance companies. The financial sector was not as integrated as it was before. But in 2002, we realized we need one supervisor and not three. So we took the Federal Banking Supervisory Authority, das Bundesamt für das Kreditwesen, das Bundesamt für das Versicherungswesen und das Bundesamt für den Wertpapierhandel, so the federal offices for insurance sector, banking and securities trading, and we merged them into the Federal Financial Supervisory Authority. Similar in Switzerland. Switzerland has FINMA, Finanzmarktaufsicht, FINMA. So this is a federal institution, and it is important to note that it's under, bad English translation, it's a legal and technical supervision of the Federal Ministry of Finance. In German we say Rechts- und Fachaufsicht. What it means is, it is not part of the Federal Ministry of Finance, but it is an organization that is supervised by the Federal Ministry of Finance. Which is important. Why? If you ever speak to someone from Deutsche Bundesbank, the first thing when it comes to financial stability, he or she will note is that we're independent. BaFin guys are not. They have to answer to the Federal Ministry of Finance, meaning that it is much more influenced by politicians. If you see what BaFin is doing right now, they are much more concerned about customer protection than other agencies. I mean, Deutsche Bundesbank is as well, but they also have to care about other things. BaFin is especially after the financial crisis, has been much more concerned about customer protection, because they are much more under the influence of politicians who care about votes and people being defrauded by institutions and companies from the financial sector. So that's BaFin. It's managed by a president and it should be 5 executive directors, Exekutivdirektoren. Why 5 executive directors? One for banking, one for insurance and pension funds, one for security trading and stock securities trading mainly, one for personnel and legal and IT operation. I think they have 5. The idea is they had back I think 12 years ago they had a scandal at BaFin, and as a result of that scandal they changed management. Before that they had a presidential structure, meaning you had an almighty president of BaFin and no one was willing to criticize him or her. So after that scandal they changed it, and nowadays the 5 executive directors are at the same level as the president. So they all have the same say, and it's a different structure of management. Now what they do is, and by the way, I always make that mistake myself. Insurance and pension systems and pension funds, only BaFin is responsible in Germany. Banks, SIFIs, ECB, banks, Deutsche Bundesbank in cooperation with BaFin. Deutsche Bundesbank does the main day-to-day work. BaFin only steps in if something's off, if there is some problems, and in case, and they set the general rules for supervision. How does it work with securities, mit dem Wertpapierhandel? How does it work with securities and exchanges? Trick question. You have to pay special interest to the original federal office responsible here, the Bundesamt für den Wertpapierhandel. What does that, why is that important? BaFin does what? It monitors securities trading and securities products, securities. Stock exchanges are supervised by local state agencies. For example, in Frankfurt, which is the main stock exchange in Germany, by the Hess state agency. Say this in German. Vertue ich mich auch immer mit. Beim Wertpapierhandel muss man aufpassen. BaFin ist für den Handel zuständig und überwacht den Handel und die Produkte. Die Aufsicht über die Wertpapierbörsen unterliegt den Ländern, den Ländereinrichtungen. Und da ist es natürlich vor allem in Hessen wichtig, weil wir da die Frankfurter Wertpapierbörse haben. Also hier muss man ein bisschen aufpassen, wenn man einfach sagt, ja, Börsenaufsicht. Nee, Börsenaufsicht, ja, obwohl wir natürlich da alles mit meinen, Wertpapierhandel, Börsen. Die Börsenaufsicht unterliegt den Landeseinrichtungen, den Landesaufsichtsbehörden. Der Wertpapierhandel, der unterliegt der BaFin-Aufsicht. And what does it mean? Monitoring and supervising securities trading. I have a great example. What they do is they monitor fluctuations and any irregularities in trading behavior. Can you give me a very prominent example where BaFin red flagged trading behavior, where they monitored, where they saw that something was off? An extremely strange example, I have to admit that. It has been now 2 years, I think 2 or 3 years ago. Anyone football fans here? The team of Borussia Dortmund left its hotel to drive to a Champions League game, and a bomb exploded on the way, injuring I think 2 or 3 players. What happened was, no one knew what happened. They first thought could be a terrorist attack, etc. After some time they arrested the perpetrator. Why? BaFin had red flagged the stock of Borussia Dortmund, and one single person with an IP address, unfortunately from the very same hotel the team was staying in, one person heavily shorted the stock of Borussia Dortmund, hoping the stock price to go down. And the supervision of the security trading of Borussia Dortmund by BaFin immediately identified the person who was later found to be the guy who laid the bomb. And this is what they do. They monitor trading behavior, they monitor security prices, and if something seems to be off, they investigate. That's BaFin's job here when it comes to securities trading. They are based in Bonn, because you know our federal government was originally in Bonn. They have a huge office, a huge field office in Frankfurt as well, but the main office is in Bonn. And again, it's under the supervision of the Federal Ministry of Finance. And supervisory authority for the whole financial sector, again, securities trading, not exchanges, insurance completely, complete insurance sector, and in cooperation with the Deutsche Bundesbank, banking sector. Primary goal, for us at least, is secure financial market stability, financial stability and customer protection, investor protection. And you can justify supervision and regulation by also stating the lack of transparency of banks. Therefore, the need for creating market transparency by extended disclosure requirements. What is meant by that? If you bring your money to your checkings account, to a bank, you don't know anything what they are up to. They can give out a bad loan, they can give out a good loan. You don't know what the bank is doing with your investment. And this opaqueness, this lack of transparency of a bank balance sheet needs to be taken into account. And because you're a customer and we want to have consumer and customer protection here, governments have decided to supervise banks more closely than, say, for example, perfume or shoe shops. And we want to make sure that not just financial stability is given, but also safe payment transactions. And we want to keep this. Banking regulation is done on at least two levels. It's done at the level of federal laws. For example, we've seen Kreditwesengesetz, the German Banking Act, but also Depotgesetz, Pfandbriefgesetz, those laws that govern certain aspects of banking. But we also have the executive branch, and BaFin is part of the executive branch that has enacted statutory or executive orders. Nowadays, we all know about this by the way Trump is doing business. But we actually have the same thing here. Does anyone know what the German word for this is, for an executive order or statutory order? We have Rechtsverordnungen. We have laws, Gesetze, and we have Rechtsverordnungen, which are statutory orders. How does it work under German law? Any idea? Best example comes from traffic, from car traffic. German Parliament has enacted a law that governs traffic on public streets. It's called German traffic law, Deutsche Straßenverkehrsgesetz. It states that basically on all public German roads the same rules apply, and that it's the job of the German traffic ministry to give out rules how to drive on German streets. Now, German Parliament didn't want to bother with coming up with all the traffic signs. So the law actually says the specific details are enacted by an executive order, I guess, of the German Federal Traffic Ministry and Transportation Ministry. This is how it's done most of the time. You have a very general rule that tells, okay, this branch of government is responsible, and the specific details are laid out by the executive as part of a statutory order. Ja? Näheres regelt eine Rechtsverordnung. And then all the traffic laws and the traffic rules, they are actually in what everyone, if you're German, everyone knows as the Straßenverkehrsordnung. It's the executive statutory order that governs traffic on public roads in Germany. And this is a huge one where you have all pictures of all the traffic signs. Our parliament didn't want to bother with traffic sign design and so on. And it's the same here. You have executive orders or statutory orders enacted by federal executive branches, for example, by the Federal Ministry of Finance or BaFin or Deutsche Bundesbank and Federal Ministry of Finance, and these lay out the specific details. Good example, solvency regulation, die Solvabilitätsverordnung. This one states how much solvency financial institutions need to keep on their balance sheet. Minimum requirements on risk management, MA-Risk. BA für Banken, MA-Risk, VA für Versicherung. We have two types for banks and insurance companies. The minimum requirements on risk management, they used to be a newsletter of BaFin. And legally it works like this. BaFin, under law, is allowed to supervise financial institutions. So BaFin has all the power. If BaFin sends out a newsletter to the public stating, we consider this and this and this to be a minimum requirement on a bank's risk management, it's not a written law. But the law, another law says BaFin is in charge, and if BaFin says so in a newsletter, you do so. You stick to it. So it used to be a circular letter or ein Rundschreiben in German, a circular letter or a newsletter of BaFin, which has now been included for insurance companies. You might know this, I think it's paragraph 45 or 48 of the Versicherungsaufsichtsgesetz. As part of Solvency II, it has entered German law, the German Insurance Supervision Law, Versicherungsaufsichtsgesetz, VAG. And Large Exposure Regulation, die Millionenkreditverordnung oder Groß- und Millionenkreditverordnung. Anyone have an idea what the Large Exposure Resolution Regulation is? If you give out a loan of, say, more than 1 million euro, you're required to report this to Deutsche Bundesbank. Deutsche Bundesbank keeps a highly confidential, in their treasury vault, I guess, a highly confidential database of all large loans given out by German banks. Because in the emergency scenario of a large bank being close to bankruptcy, they want to know exactly which companies have taken a loan from this bank and which interdependencies you have in the financial sector. Das ist die Groß- und Millionenkreditstatistik der Deutschen Bundesbank. Very simple instrument, and this is done as part of banking regulation. I told you that BaFin is in charge, and it is because of paragraph 6 of the German Banking Act. Paragraph 6 Absatz 2 KWG states that BaFin shall counteract undesirable developments in the lending and financial services sector which may endanger the safety of the assets entrusted to institutions, impair the proper conduct of banking business or provision of financial services, or entail major disadvantages for the economy as a whole. And you can immediately see why we are regulating banks and supervising banks: customer protection, financial stability, overall macroeconomic effects on the whole economy. That's why we allow BaFin to supervise banks. On a more general note, again, remember that you're studying economics and business, and at least in our free social market in our market economy, supervision and regulation is not good. We want our companies to roam freely in a free market under some rules, so that we can call it social market economy, soziale Marktwirtschaft. But as a general rule, influence by the state in a free market is never good. It creates inefficiencies. So for the state, for the government to intervene and to supervise banks and to regulate banks and financial institutions, there has to be a good reason for that. We don't supervise shoe shops. They can sell crappy shoes. We don't care. We don't regulate the perfume store, but we do regulate banks. So in a free market economy, there has to be a good explanation for this. And the justification for banking regulation is this. It's seen here: customer protection, financial stability, and the proper functioning of a financial sector in order to support economic growth. Banks are just too important for us. That's clear. Paragraph 6, Section 3, KWG says, BaFin may issue orders to institutions and their senior managers that are appropriate and necessary to prevent or stop violations of regulatory provisions or to prevent or overcome undesirable developments at an institution which could endanger the safety or the assets entrusted to the institutions or impair the proper conduct of its banking business or provision of financial services. Meaning that it has some pretty powerful instruments at its disposal to force institutions to stick to the rules. Section 4. In exercising its functions, BaFin shall duly consider the potential impact of its decisions on the stability of the financial system in the EEA states concerned. This is just a provision that has been included to make sure that BaFin acts in the best interest of the European Union and not just Germany. Paragraph 7, Section 1. BaFin and Deutsche Bundesbank will cooperate as stipulated in this Act without prejudice to further legal provision. This cooperation encompasses, we call this laufende Überwachung, the ongoing supervision of institutions by Deutsche Bundesbank. This is done, for example, here in Leipzig as well by Bundesbank's regional office, die Hauptverwaltung für Sachsen und Thüringen, local regional office for Saxony and Thuringia. Ongoing supervision notably entails evaluating the documentation submitted by institutions, audit reports pursuant to paragraph 26, and annual financial statements, as well as performing and evaluating on-site inspections. Any idea what this means? Ongoing supervision. In fact, it's close to an audit by a certified public accountant. Ja, das ist ähnlich wie eine Wirtschaftsprüfung. Ja, wenn der Wirtschaftsprüfer vorbeikommt und die Bücher prüft, Sie haben dann eben nur Bankprüfer, ne, Bundesbankprüfer und Aufsichtsprüfer. Die schauen sich andere Unterlagen an, schauen sich andere Dokumente an, weil natürlich auch andere Sachen geliefert werden müssen. So this is ongoing supervision, and this is done by Deutsche Bundesbank as performed by its regional offices, the Hauptverwaltung. Supervisory authorities and regulators regularly use the following instruments. More generally, and the paragraphs show you what we have specifically in Germany. We have capital requirements, assessing institutions' liquidity, authorizing business operations or prohibiting and forbidding certain business, monitoring bank risk in individual transactions, and giving out warnings, fines, banning certain members from doing business, and so on, and withdrawing licenses. We'll talk about each of these after the break. Do you have any questions? And I would say let's stop here and continue in about 15 to 20 minutes. Okay, thank you.